And joining us now with more, Julia Coronado, MacroPolicy Perspectives president and founder, and a former Fed economist. Everybody's wearing this color today,
only
Julia.
One without red.
I know, red. I was just noticing that.
We're all jazzing up for the Fed today. I'm not sure if Jay Powell quite rose to the occasion as well. I mean, basically, it feels like at this point anything could happen, Julia. I mean, the July meeting is live, but they're going to wait and see what the data shows. We might have 2 more rate increases by the end of the year. There probably won't be another couple of rate hikes until for the next couple of years. Like, what's the bottom line here?
Yeah, the message is pretty garbled. You've raised your outlook for growth and inflation, but you're pausing. For him to cite that the Fed funds rate is back to where they thought it was might need to go before the banking crisis suggests he doesn't expect the banking credit tightening resulting from the banking turmoil to weigh heavily on the outlook, but that's a key source of uncertainty. So it seemed to mainly be about a couple of things for me. One, slowing the pace. He said that a bunch of times. We're slowing the pace, which is just a way of sort of injecting, a little, just, taking into account some of the uncertainty as they come into that peak rate. And then the other thing is to hold the threat of rate hikes over the market for longer. I mean, if you think about, putting 2 hikes in the baseline essentially takes us through year end at this new slower pace. So they're not going to cut rates this year. That's been a message that they have been saying, but now this really puts, kind of an emphasis on that. Stop it, markets. We're not going to turn from rate hikes to rate cuts very quickly, and it's really not in the cards for this year. So in some senses, but if you look at the skew of the dots is below the median now, whereas in March it was above the median. So that's the baseline is 2 hikes, but there's more people who think that they'll do 1 or they're already there than think that they'll have to do more than 2. So, that kind of adds a little bit of a flexible tone to this otherwise pretty hawkish message.
Yeah, Julia, I sort of feel myself sort of swaying back and forth with what we've heard from the Fed. But let's work with the expectation now. If the expectation is 2 additional rate hikes, and you look at where inflation is right now, yes, we are more than double where the Fed would like it to be at well above 4%, but we have seen the prices come down. We have seen a cooling here. Does it make sense to look at additional hikes, 2 additional hikes by year end, considering where the data is right now?
So I think Powell's answer to that question was about, how often they have had head fakes on inflation and how often they have been wrong, and that they really need to see more decisive evidence. We think they're going to get it. We don't think they'll go 2 more times. We think they'll go once more. But, there are a lot of leading indicators pointing towards cooling in core inflation. Obviously, headlines already cooled. That's one leading indicator. Also, used car prices and shelter. He talked about a lot of these dimensions, but they need to see that materialize. And so I think if they do see it materialize as we expect, they will be more flexible. And they don't seem like, again, the skew is towards less, not more. So, if they actually get more moderation in inflation by, say, November or even September, maybe they'll take that hike out of the baseline in the SEP, or keep it and then just skip it in November or December. So we think the stars are aligning, but again, they really want that confirmation in the data, and they still seem a little bit scarred by being behind at the beginning of this inflationary episode.
Julia, it was also interesting what Powell had to say about the labor market. Obviously, that's more lagging indicator, but even there, he talked about signs of progress. Let's play what he had to say, and then I want to get your reaction.
There are some signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has declined, labor demand still substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on inflation.
So, again, here it's sort of a balance, if you will, but it does seem like all signs point to progress towards the Fed's goals, right?
Yeah, absolutely. And by the way, that progress in the labor market is coming from a source that they had already counted out. They basically had said late last year they didn't expect any improvement in labor supply, yet we've gotten substantial improvement in labor supply this year. So, that's been definitely an upside surprise. He's acknowledging it, though he's still calling the labor market very, very tight. So, again, swaying back and forth. There is a little bit of a mixed message here, but yes, a lot of things are showing their policy is tight. The economy is moderating. It's coming into better balance. Leading indicators of inflation are cooling. The composition of inflation is optimistic, points to some optimism. The labor market looks really nicely soft landing so far. We've gotten moderation in wage growth without a rise in unemployment. This couldn't be better news for the Fed. But again, they just really want to see more convincing cooling in inflation itself, in the core measures of inflation itself. And again, if they get it, I think they're going to be perfectly happy to be more flexible here.
Julia, it seems like, at least on financial Twitter, that Powell is getting a lot of criticism over saying, skip, I shouldn't call it a skip. And, we go through this song and dance every time where his language is really scrutinized. And I guess on the one hand, you should say, well, he should know by now. But on the other hand, maybe the market should know by now. Like, who's the problem here? Is Jay Powell and maybe imprecision the problem? Or is the problem that we are parsing his language too obsessively?
I think the problem is that you've got a big committee with mixed views. And when the chair gets up at this press conference, he has to do his best to strike the balance and represent the totality of the committee. And so you can get some garbled messages from time to time. This was, one of the reporters asked, what's the narrative here? You've raised your outlook and yet you've skipped the meeting, but you've added more hikes. What are we supposed to make of all of this? And, there's no really great answer other than, clearly the banking crisis is at the heart of their decision to skip. Had we not had the banking crisis and we had had the same flow of data, they probably would have gone. The fact that there is a lot of uncertainty around that, and then there was the debt ceiling, and now there's the restoration of Treasury funding after the debt ceiling. There's just a lot of things that led them to decide to just slow things down a bit. Every time he's sped things up to like throwing 50 basis points in the mix, things break. So, going slower allows them to tighten things a little bit more gradually and flexibly. And yeah, it's kind of a mixed message, and it doesn't all add up. And I think what we need to acknowledge, in all fairness, is that we're just in the middle of this extraordinarily uncertain time. Just think about how many mood swings we've had in the market so far this year. From hard landing to soft landing to, oh my God, inflation is coming back and the Fed's going to need to hike faster, to, oh my goodness, we're, in a banking crisis. It's been wild. And so formulating a baseline forecast and even evaluating the risks around that forecast is challenging. And then when you're talking about 18 different people doing this and then communicating a coherent policy message, sometimes it gets a bit muddied.
And potentially, expect to experience more mood swings between now and the end of July with the next FOMC meeting takes place. Julia Coronado, it's good to have you on today, MacroPolicy Perspectives President and Founder.
Thank you for having me.